Okay, Poonam, we'll leave it at that. A lot of questions in front of us, whether the localized lockdowns are going to derail earnings momentum, whether commodity inflation is going to eat into the margins, and will markets then ignore first quarter and focus on a normal second quarter? What really is the market positioning, and what is it that we can expect from India Inc.? Joining me right now, Gautam Duggad from Motilal Oswal Securities, Head of Research, to analyze what each of the sector is likely to do. Gautam, hi, good evening. Great to have you on the show. Let me begin by talking about autos. While we did have commodity cost inflation keeping the margins in check, but on the other hand, that also got diluted by price hikes. I mean, as recent as a month back, you had Hero MotoCorp, Maruti, and then Tata Motors announcing 3 price hikes in this year alone. What is it that you are expecting from autos as a universe to deliver?
Sequentially, auto is going to see a massive moderation in margins. So we are expecting almost 350 basis point of sequential moderation in operating margins for auto. This is excluding JLR numbers. And that in a way reflects the cumulative impact of 2 factors. One is the rising commodity cost across the board. And second is the operating deleverage, which might come in because you were shut down for 2 months. So you just kept on producing the vehicles, but the retail market is shut. So there will be an operating deleverage impact as well. Cumulatively, that is hurting the margin by about 350 basis points. But the monthly numbers that came 2-3 days back for June, they were quite staggering. The numbers were a beat across the board, whether it is tractors or passenger vehicles or even two-wheeler. Hardly 1 or 2 companies did not meet expectations. Most others have beaten expectations. So one needs to see for at least another 3-4 months if June number is just a pent-up or if this is sustainable. My view about since last 6 months has been that auto is one sector which faces the maximum earnings downgrade. And that is how it has panned out so far. Even in this quarter's number, I am seeing a slight downward revision in auto estimates, whether it is for Maruti or it is for Eicher. And that is understandable because for April and May you did nothing. But from here on, it is going to be very interesting to track the monthly numbers because we will, in a month or two, we will head into the festive season. Last year's festive season was a blockbuster festive season. So you will again now, start looking at numbers on a slightly higher base. But this quarter looks good because June 20, our universe in auto sector posted a loss. Versus that, we are obviously going to see a profit. But sequentially, it will be a massive moderation because of what happened in April and May. We are relatively neutral in our model portfolio for auto.
Right. Gautam, given that a large part of the market does believe that the cyclical recovery still has more headroom, what is it that you're expecting from capital goods as a sector? I mean, will they attain normalcy by the financial year end? Can flat orders, what they saw in the previous quarter performance, can we see a meaningful uptick in order inflows?
This is a very interesting space. It has been virtually dead for the last 5 or 6 years. Capital goods, we've not seen much happening because of the lack of private capex revival. There are very early signs and noises from the management commentaries which are coming, which suggest that next 2 years you can see some sort of a revival happening in private capex. And government also is putting its muscle behind it with variety of PLI schemes and focus on manufacturing. As far as this quarter is concerned, you will see that execution of the EPC companies and infra companies and capital goods companies, this is far better than what we had seen in the first lockdown, which was 1Q FY21, because you've seen very localized lockdowns plus factories were not shut and, some sort of execution was going on. So maybe not as good as what we saw in 4Q FY21, but 70 to 80% of 4Q FY21 is what we are looking at. And the downside is the margin because not all contracts have built-in provisions of passing on the costs. There are a lot of contracts which are fixed cost basis. So when commodity prices go up, it hurts your margins. So we are going to see twin impact. The execution will not be badly impacted, but margins can be. And all of this obviously is happening on a very low base. So YY numbers won't make much of a sense. The 2-year CAGR base, the numbers will still be lower versus what you saw in June 19. Interestingly, from here on, if execution picks up, and as you mentioned, if order books also start coming in and, a variety of agencies like NHA and all, they have very ambitious targets for the next couple of years. If that starts percolating, then numbers can look very different. And a space which has virtually done nothing over the last 4 or 5 years can open up. This is how we were caught off guard when metals started rallying last year after going nowhere for almost 6-7 years. Possibly it may happen in cap goods also, provided we don't run into multiple waves of COVID. That's a different matter altogether. But if we assume that normalcy comes back, then this is a very interesting space to look at, both from a large cap and a mid cap point of view.
I'm going to talk about cement as well as a pack, Gautam. Given that it's been very buoyant as well of late, all the stocks have been holding up quite smartly. You think better realization will continue to offset the kind of raw material cost pressures that cement manufacturers have had to undertake and bear?
Cement, you've seen a very blockbuster year. FY21 was one of the best years for cement. And all the 4 quarters of FY21, cement has done exceedingly well. In fact, if you look at the performance of the year gone by, then cement and pharma are the only 2 sectors where we've seen all the 4 quarters delivering very strong numbers. And it's a very good way to play the infra/capex story if you don't want to get into companies with heavy debts, right? The cement is a good indirect way of playing the same story, and that's why we like it. We have a big overweight on cement in our model portfolio for last more than 1 year. Apart from just pricing, what I'm excited is FY21 has seen a massive deleveraging in cement and metals. And that is reflected in the way free cash flow growths have turned on. Companies have delivered more than 100% growth in free cash flows in FY21 versus FY20, right? And because of the cash flows that they generated, they clearly paid out their debts. So massive deleveraging has played out, whether you talk about large caps like Ultratech or even mid caps like JK and some of the other names which are there in the sector. This is a very interesting sector for someone who wants to play the capex story of India without getting into the order books and EPC related sectors where there always is a lot of volatility and balance sheets are relatively less they have leverage on their balance sheets compared to cement companies. There can be some quarters here or there where the impact of the pet coke prices and other commodity costs which have gone up, freight costs, diesel costs and power costs may impact margins marginally in a quarter or two. But I think they are very well placed, both from a demand point of view, pricing power, and at the same time, more importantly, the deleveraging which has played out. This looks a very interesting sector to us.
Sure. Gautam, since we're talking about the impact of raw material cost pressure, there isn't a sector which is facing more heat than what's happening across the consumer basket. Sure enough, they have been taking calibrated price hikes, but then, the overhang of the RM costs continues to lurk. That said, the bigger worry or the bigger problem from a stock market perspective for the entire consumption basket is not growth, but also about the kind of valuation multiples that most of these stocks are sitting at. How do you think consumer companies will try and maneuver in the first quarter and going forward?
They've been in consolidation phase for last more than a year now. If you look at the trailing 12-month returns of Nifty constituents, the bottom 5 stocks out of that 4 are FMCG stocks, the likes of Britannia, Lever, Nestle. So a lot of consolidation, time correction, as you want to call it, has already happened. I think, one has to really take a long-term view on consumption in India because this is definitely an evergreen space. If you had looked at 1 year forward P multiples 3 years back, you would have found them equally expensive and you would have missed out on names like Titan, Britannia, Lever, Pidilite, Asian Paints, Tata Consumer, So in consumer, you really have to take a long-term lens. There will be a lot of noise along the way. Sometimes it will be commodity costs, sometimes it will be advertising expense, price wars, lockdowns may impact demand in the near term. But I would suggest, investors should use every such opportunities to accumulate these shares because they've really compounded well over a period of time, whether you look at it from a prism of 3 year, 5 year, 10 year or 15 years. The thing to note here is one has to look at sector leaders is where there is a pricing power. Then obviously even if you buy a slightly expensive, the leadership of the sector and pricing power ensures that you still end up compounding reasonably well over a period of time. That is what we have seen, the evidence. So what we like in that space, that has not changed much in the last 5 years. We still continue to like Lever. Britannia, Titan, Pidilite, and Tata Consumer. These are our five preferred picks in that space. And every decline, I would think, is a buying opportunity for someone who has a 3 to 5 year view, because we are clearly going to see a pickup in the per capita disposable incomes. And if that happens, then clearly the consumption space cannot remain insulated from the in general upturn in the economy that we might say, because we still are a consumption driven economy with 60% of the GDP accounted for by consumption. So yes, I agree, valuations are expensive, and somebody who has a 1 year view or a 6 months view should clearly not step into this space. But somebody who has a 3-5 year view, this space remains evergreen.
Right. Gautam, when it comes to banks purely, the asset quality trends have been holding up well. If the first quarter commentary from everything from an HDFC bank to a Bajaj Finance to an AU Small Finance Bank, across the spectrum is anything to go by, it clearly indicates a very healthy trend in business momentum. Plus, of course, what we've seen in the quarter gone by is the re-emergence of PSU banks as well in particular. How do you think banks should be looked at, and whether or not there is better value now in PSU banks as opposed to the private lot?
I think banking is the best open up trade in the economy because it allows you the size to deploy your capital. And at the same time, we have seen the evidence of FY21, where at least the large cap banks, the top 5 or 6 banks that you have, they've come out with flying colors in FY21. Whether you look at it through asset quality prism, the provision ratios, liquidity, the capital adequacy ratios are at a decadal high. And I think the big banks have clearly gained market share from the mid and small, players. Now, what is happening is this second wave of COVID has introduced an element of uncertainty for 1Q and 2Q FY22 numbers, which is what has actually resulted in some sort of an underperformance for the bank Nifty. But if you go by the commentary, most of the banks which have come out with their commentaries over the last 3-4 days, two things are evident. Loan growth expectedly has moderated, and deposit growth has by and large kept pace. And if you go further, take a deep dive into the commentaries of the banks over the quarter, you will find that nobody is talking about a big, massive level of restructuring yet. So what we have seen in FY21 may continue. In fact, if you see the profits, just the numbers, the Nifty BFSI profits have bottomed out in FY18 at about 43,000 crores. From there, we've already done 1,20,000 crores in FY21. So profits have gone up 3x in the last 3 years from the bottom.
So Gautam, looking ahead into the first quarter and given the market positioning, do you think there is scope for any earnings surprise, or do you think one should worry about downgrades at this juncture?
You're talking about a quarter where there are too much of disruptions already. You've seen YOY disruption, sequentially there is a disruption. So I don't think there is material room for earnings surprise because expectations are very high. When I'm talking about 128% profit growth for the quarter, I'm saying that barring consumer, IT and pharma, where the expectation is about 15-20% growth, most other sectors are expected to report a very sharp swing in earnings. Where I think there could be some potential for surprise here and there is, select spaces like mid-cap IT, or for that matter, specialty chemicals, where we've just put out a coverage, sector coverage a week or so back. But the room for earnings surprise, I think, is very limited. I would be very cautious on actually, if at all there are any downgrades that can happen, because the expectations are very high right now. And on those expectations, I am happy to be proven wrong if there are surprises. But yeah, I would pragmatically think that there is room for some downgrades, if at all, from this earnings season.
Gautam, great to have you on the show. Thanks as always for taking the time out. Let me also welcome on board then Pankaj Pan.